Hey, Juan.
Hey, Duncan.
How's it going?
All right, Marlo should join us shortly.
Cool. Hey, Eugene.
Hi there, Duncan.
Cool. All the presenters are here. That's the most important thing.
Hopefully you can hear me.
Yes, I can hear you guys fine. Mark, Stephen, I think you guys are good as well, huh?
Right.
Cool.
Hi, everyone. I think I'm on. Can everyone hear me?
Yeah, we got you.
Oh, perfect. Cool.
Well, guys, as long as everybody can see the screen, I think we can kick off. Anybody else that arrives, I will take them into the waiting room. And if there's any questions, guys, the chat is going. So please feel free to put something in the chat. And we can always raise it towards the end or even as we're going along. So pretty informal, guys. I don't want to sort of stand on any ceremony, and we'll kick off now. But guys, if you could maybe just keep your microphones muted. If you have a question, raise your hand or do that. And I'll be watching that quite carefully because I'm a passenger. I want to talk as little as possible in this session. I'm going to hand over to Eugene and then to the guys from OMBA straight after this. So welcome. Everybody can see the screen. If anybody has any questions, just shout. So the big thing for me was just to actually start off this whole presentation journey. And this will hopefully be one of the first of a couple of online sessions for clients, friends, and family. Just introduction to what we do here in Perspective in terms of wealth management and also just financial planning in general. But specifically today's session is just an introduction to the insights and the links that we go within Perspective to create an appropriate and modern wealth management solution for you as our clients. And specifically today, we're talking about offshore investing. I love the example that I actually heard, so I can't claim this as my own. But if you're an alien and you had landed on the world and you had $1 million to invest, which would wish you all had $1 million to invest, where would you put your money? And the truth of the matter is, as a South African, you put all your money in South Africa, but as an alien lands on Earth, you would only put maybe 2%, maybe 5 or 6 if you're really aggressive in emerging markets. But I'll leave the asset allocation to OMBA and the guys from Stephen to chat about, Stephen and Mark. But it's a really good example because if we are, as South Africans, we are horribly geographically exposed because we have a lot of our assets in South African investments, including our property and our retirement investments. And offshore investing is actually super easy and it's not that difficult. And that's what I want to try and get across to everybody today, especially the South Africans on here. I've got a couple of foreigners on the call, but well, people that don't live in South Africa, but it really isn't that difficult. And that's what I'm going to try and show you guys today. And then also just expose you to the wealth management strategy that we have implemented with the assistance of OMBA and on the Momentum Wealth International platform. And part of that is our base investment strategy or wealth management strategy. And that is obviously to try and offer the best market returns that we can. But also we like to focus on index strategies because you know that in the greater scheme of things, the only thing one can control is costs. And that's really the only thing you control. We can't control where the market's going to go or what's going to happen. So we can control costs. And you do that by having an index or passive strategies. And we found a kindred spirit in OMBA. Mark I've known for a very long time. And so when he came across our desks and I found out about his investment company, I was like, wow, this is meant to be. And so we've created quite a different kind of strategies, offshore being the one that we're going to talk about today. And the local strategies we're still implementing, and I'm going to introduce those to the South African market in time. But today, really, it is just going to talk about their strategy they've implemented for us and themselves as investment managers. And then also just to talk about Momentum Wealth. Why have we chosen Momentum Wealth? And I'm going to obviously get Eugene to talk about his platform, but really the most important thing that I like about them is their flexibility and the access that we've created on their platform. So it really is an open architecture platform. We can get any funds and flexibility to switch and also to pay anywhere in the world. So I'm not going to speak too much more about that. I'll let Eugene introduce Momentum Wealth as per the agenda. And then I'm going to hand over to OMBA. And then the timings are a bit of a guideline. If you guys do have any questions, please just shout. And as I said, raise your hands in that. Quick little introduction to OMBA before I hand over to them. So in 2017, Mark Perchtold and Dave Pearson formed OMBA. Mark was an accountant in South Africa. He went to CARES. That's where I went to school at the time. I know him. He worked for Goldman Sachs for 12 years. Once again, they believe that costs are important determinant, and he decided to start his own low-cost ETF or exchange-traded fund business. Then David, in line with this, designed his own systems which manage the business and do things a lot more cheaper and more effectively. They've run this for a number of years, and they have 6 investment professionals in the business, all hailing from South Africa, and they have a new member who joins in September. Stephen, who also is on the call, he's been in the multi-management business and as a portfolio manager for over 12 years and has worked at companies like Old Mutual. Headed over to overseas recently to actually join the OMBA crew. So I'm going to hand over to them now, or no, then later, but I'm now going to hand over to Eugene from Momentum Wealth International. So guys, Eugene, off you go. Thank you so much. Do you want to share the screen, Eugene, or are you good to talk?
Yes, no, definitely. Let me quickly just get it on here for us.
I'm going to stop sharing and it's all yours.
Okay, great stuff. Duncan, just let me know, you can see the presentation, full screen, everything's fine, hey?
Everything's perfect.
All good. Okay, thank you so much for the time. And obviously the introductions, I think you've positioned it quite well. I've got a similar example that I generally use when discussing international investments and the platform specifically. But for today's purpose, I thought of introducing just Momentum Wealth International as a platform as a whole, where we're domiciled, and just a little bit more about the platform specifically. So I'll talk through some of the details. But firstly, I think just to add on to what you've already mentioned earlier, there's obviously always the question of why should I actually invest offshore? And I picked one of a number of examples that you can actually use just to illustrate that whole point that you just made. If we look at this is world GDP by country. So just South Africa as a proportion in relation to the world, just in a very nice graphical representation. So if we look to the far bottom right-hand corner there, we can see South Africa representing pretty much 0.4%. Now, this is from 2019 data, but currently it's still more or less the same. And the scary thing about this statistic is that the South African indices, as far as the JSE is concerned, is pretty much exactly the same proportion of the world's stock markets. So from that perspective, it's almost like trying to put together a sports team and you're only limiting yourself to 0.4% of the population. So the opportunity set is just so much bigger when you start talking international investments. And that's one of the reasons why I think it's so good or so important for us as South Africans to invest offshore, to open up our money to the entire world. So I think this just gives that whole picture of why it is actually good to invest offshore. And like I said, there are a number of reasons behind it, but this is just one that I like to touch on normally that puts everything into perspective as far as the opportunity set is concerned. So the next couple of slides, I'll just briefly talk to how we actually invest offshore from a South African perspective specifically. So us and South African residents, there are 2 types of allowances that we as South African residents have, and this allowance or these allowances are only available to individuals older than 18 years. So individuals have a single discretionary allowance of 1 million that you can take overseas per annum. This includes money that you normally take overseas when going on holidays or whatever the case might be. So that is all included in that 1 million amount. And then we have an offshore investment allowance of 10 million. So this is an allowance that SARS and the SARB provide us as individuals, where we can get clearance to externalize our monies and invest it internationally. So within a family unit, the maximum is obviously 22 million that you can take across between husband and spouse. And that obviously then translates through to the options that we have from an investment perspective. So the next slide pretty much just touches on some of the high-level processes. So first and foremost, us as South Africans, we need to externalize our assets. And for that purpose, we need to get the necessary approval from SARS and the Reserve Bank. This is only for investment amounts above $1 million. So for anything less than $1 million, we can take offshore without any clearances or any requirements from SARS or the Reserve Bank. That obviously bodes quite well because it's easy enough to just externalize less than the $1 million offshore. That said, when it comes to investments larger than $1 million, it's not necessarily a case that it's a complete difficult process to try and get through. A lot of foreign exchange providers and retail banks, for that matter, assist in this process. So what they would normally do is they are the ones that obviously help you in converting your rands into foreign currency, but they are also the ones then that take you through the process or assist you in the process of getting the necessary approvals from the Reserve Bank and your tax clearances. A lot of them do this free of charge as part and parcel of doing the exchange for you. So there are a number of providers that you can look at. We've also partnered with one specific provider directly on the platform, so making the exchange process a lot easier and a lot smoother for you as clients to get your monies converted. So obviously, once we've got then the necessary approvals, we've gone through the process, the money is converted into hard currency, and then you basically invest it directly onto the international platform. So we don't accept any rands directly onto the platform. It has to be an international currency in the form of US dollars, British pounds, or euros for the like, and a number of other ones as well. So that's just a very simple high-level process. The note that I made on the top right-hand corner there for you is obviously pointing back to the process of taking the monies offshore. I think a lot of people prefer using their retail banks. That comes with its own costs at the end of the day. As I mentioned, normally going through a foreign exchange provider gives you a much better rate when converting your currency from rands to a foreign currency, and that obviously aids in the investment process. You don't want unnecessary additional costs when doing it. But in terms of simplicity of the process, I think it's very, very straightforward. And a lot of people get scared when you start talking SARS and Reserve Bank approvals, but in actual fact, a lot of it is very, very simple and straightforward. And from a clearance perspective, obviously provided all your tax affairs are in order. So there's normally not that many issues that pop up, but every now and then it's something just to keep in mind when going through the process. So Duncan, sorry, I'm not keeping an eye on the chat box. If there is something, maybe just let me know. If it comes through, then we can take it, or we can answer later on. Easy.
Perfect. All good. No questions yet.
All right, then maybe just to introduce the Momentum Wealth International platform. So we are a wholly owned subsidiary of the Greater Momentum Metropolitan Group. We fall under the Momentum Investments arm of the business. So we've been in existence since 1999, domiciled in Guernsey. Currently, we've got just under 3.3 billion in assets under administration, $3.3 billion. And at this point in time, obviously, the business is growing quite nicely. There's obviously a number of factors that get clients to be more open, but I think the world has changed quite a bit for us as South Africans specifically, and more recently with the COVID enforced changes that we needed to employ within businesses and within our day-to-day lives. People are becoming much more prone to taking their money offshore, and they're becoming much more open to it. So I think from a platform perspective, that obviously bodes well for us as a business. And I think at the end of the day, we as a platform are here to make it as simple and as easy as possible for investors to take their money offshore. So in the next couple of slides, I'll talk to why we opted for Guernsey as a domicile or jurisdiction to house our business, because that's obviously very important for you as investors and for us as a business as well. And then lastly, I'll talk about some other capabilities. At the end of the day, an investment platform is pretty much a supermarket for investment options or for investment components. So you come to an investment platform to get the scope of investment options that you wouldn't normally get from one particular provider, where it saves you the time of going to individual points or individual places to get the various investment options that you would need. So this is obviously a little bit of a busy slide, but I'll touch on 2 or 3 points specifically that I want you to focus on. So obviously we get the question quite a bit, why you opted for Guernsey as a jurisdiction to house your business. Now, from a business perspective, we needed to look at financial centers globally. And a financial center globally is basically just a country or a jurisdiction that caters for financial transactions and investment capabilities for people outside of that country. So that is one of the reasons why we opted for Guernsey. They've been a financial center internationally for more than 50 years. So with that comes a very long track record of being open to non-resident investors as such, and for making financial services capabilities available to investors outside of Guernsey. From a regulator perspective, they are very flexible and pragmatic. And what that does for us as a business is it means that they are quite open, or they've got a very open door approach when it comes to new rules and regulations that may come in. And obviously that bodes well, because you don't want a regulator that's very, very stuck on how they want to implement things and makes it difficult for you as a business to operate there. So for us, that is very, very open and a very nice approach in terms of the Guernsey financial regulator. And I think maybe just lastly, right at the bottom in the middle there, it's a long name, the Financial Action Task Force, but what they basically do is they prescribe certain requirements or recommendations to financial institutions, what they need to adhere to in order to combat terrorism activities, anti-money laundering, and the like. So from an international perspective, I mean, it's easy to see how quickly money can disappear nowadays. And I think this provides you with a very comfortable view of why we opted for Guernsey in the first place. From a regulatory standard perspective, it provides us as a business with a lot of benefits, but also a sound mind that your investments are safe. It's not something like you putting money into a Swiss bank account and the next day it's gone, someone's taken it, or something that happens to it. So there's lots of layers to it, lots of regulatory standards and requirements that go into the business and into structuring your investment. So I think from that perspective, what I wanted to achieve with the slide is basically just to give you sound mind that when you invest on the international platform with Momentum, a very, very stable jurisdiction. And it's not like you need to have sleepless nights of where your money is actually going to. So that is one of the big reasons why we opted for Guernsey specifically. So the next slide is quite busy, but what I tried to capture in this one specifically is just to show you all the benefits that an investment platform provides you as an investor. So from an administration perspective, it's efficient and straightforward, because now you're dealing with one investment platform with one product, for example, that has a multitude of investment options in that one investment contract. So you don't need to go to a stockbroker for your share portfolio, for example, and to an asset manager for your funds that you've purchased, et cetera, et cetera. So from that perspective, it consolidates all the administration into a single view for you within the product. And that makes it a lot easier for you to manage and to look at these options. From the platform specifically, we've also then got the benefit of having multi-currency options. So if you have needs based in various currencies, you can have 3 or 4 different currencies within a single contract with us, or within a single product with us, without having the need to have the product split between the various currencies. So that offers a nice benefit if you've got needs based in euros, for example, or future objective or requirement in US dollars, you can accommodate both in one investment contract. From an investment perspective, obviously the range does get quite daunting. At this stage, we've probably got 1,200 funds on the platform, but that is obviously where Duncan and the team at OMBA come in to simplify that whole process for you. But the options are there, so the flexibility is at least there. If something does pop up that you like or that you wanted to incorporate in your investment portfolio, I'm sure that the range of investment options does cover it from the platform perspective. And I think the next 1 or 2 points that I wanted to mention, especially for us as South Africans, it's very important from a tax perspective and from a succession planning perspective. So depending on the product that you utilize on the platform, there are a number of benefits attached to each of the products. One of them being a very tax efficient structure from one of the products, which is our international endowment. And that provides you with a lot of ease of administration. So it takes the burden of reporting to SARS out of your hands, because we do it from our side directly to SARS. We deduct any applicable taxes that do come up during the course of the investment, and we pay that over to SARS. So from that perspective, it's a nice and simple, easy approach for you to manage. And then from a succession and estate planning perspective as well, it's obviously always good to have these structures in place, because you can have the best investment portfolio structured for you, but if it's in a product or in a solution that's not tax efficient or that's not efficient from a succession planning perspective, it obviously negates quite a lot of the hard work that the investment team does. So that's why I see the two playing a very important part together to provide you with your end objectives. And then lastly, obviously, the online tools and capabilities. I think the platforms nowadays, as far as products are concerned, is pretty much agnostic. The products don't differ too much from one platform to the other. So for us as a business, it's always important for us to provide you with the necessary capabilities and tools online to view your investments, to play with your investments, to look at information around it. And from that perspective, and obviously to do the necessary reporting wherever you find yourself in the world. If you need to do tax reporting or whatever the case might be, the tools need to be there to provide you with the ease of doing those type of things. Then obviously from a platform perspective, as your assets grow on the platform, fee aggregation comes in and it becomes a beneficial option for you, rather than having lots of small pots all over the place. With various investment managers, with various providers, the benefits do then add up quite nicely from a platform perspective. So I think I tried to cover quite a bit, and I purposefully kept it short and sweet, because I think it's more important to talk to specific options and questions that you might have, rather than going through all the technicalities specifically. So Duncan, happy to finish off there if you are comfortable, and then I'll take questions, or we can do it right at the end.
Perfect, thanks, Eugene. So there was a question from Irene around the CGT and the endowment, which I have answered. But I mean, you can check the chat and just make sure that I'm correct. But I think I am. And if there's any other questions, guys, we can take them now quickly, or we can hold them to the end. If anybody's got anything burning they would like to ask now. Nope. Can't see any hands. Haven't seen anything else, so it's all good. Thanks, Eugene. Appreciate that. I think the very important thing is the Momentum Wealth and whoever your forest provider is. It's a very smooth process to get the money offshore into MWI. So it really is quite an easy process, guys. There's no reason why you should say it's difficult. It's very easy for us to get it offshore. But the next presentation is as to what happens once you've got it offshore. And so I'm going to hand over to Mark and Stephen from OMBA. As I said, I did the intro first. I should have done the intro now, but I'll do that. I'm not going to repeat it. As I think you guys heard it, but Mark, Stephen, I'll hand it over to you guys. I'm not too sure who's going to start. I think probably Steve and then Mark, but you guys got it, and you should be able to share the screen if you want to share. Okay.
Thanks, Duncan. I think, Stephen, I don't know if you want to do a quick intro and give a little bit of background on your experience in South Africa and why you liked what OMBA was doing, and then I'll give you guys a bit more detail on what OMBA is about and how we look after your money. So I'll hand it over to you, Stephen, initially, and then I'll jump through some slides.
Cool, thanks. I seem to be having an issue with my camera. It looks like I'm looking at the ceiling, but I'm actually looking at my camera. It must be a Zoom thing. Anyway, you're not here to see me. Mark just wanted me to talk to you because I am a South African. I've recently immigrated to the UK. I'm fresh off the boat. I've been here 2.5 months. But I think what's quite important about my role is I've taken over the fund distribution of the business to connect with clients and planners and platforms and the like, because I do know the business, the industry quite well in South Africa. I was with Old Mutual for 12 years back in Cape Town. As I say, I've just recently got here. I was on the investment side. I worked for a business called Old Mutual Multi-Managers. I don't know if you guys are aware of that business. It was previously part of a business called Symmetry Multi-Managers. So I was very active as a senior portfolio manager there. And then also in the later parts of my years there, I was head of the business development and marketing for the business. So my role was about interacting with clients and brokers on the business, what's happening in the funds and things like that. So I will be interacting with Duncan a lot going forward, and hopefully presenting to you guys a lot more going forward, once things are running. But I think we'll hand over to Mark now. Mark's going to share a presentation that we prepared for you, just really setting up what OMBA is, who we are, kind of how we do things, how we manage the portfolios, and maybe a look at some of the portfolios and some of the positioning. And as Duncan said, if you've got any questions, I'm happy to man the chat from Duncan. If there are any questions that are specific to OMBA, but otherwise, we can take questions during the presentation. So I'm going to hand over to Mark. Thanks very much.
Thanks, Stephen. Can everyone see the screen? Duncan, can you see the screen?
Yep, I can. Anybody can't, just shout.
Great. Well, thanks everyone for your time. I think some very interesting points have been made, which I'll just sort of reiterate. That the first was made by Duncan about thinking about if you landed on the planet today, how much money would you invest in your home market, and if your home market South Africa, how much would that be? And then the slide Eugene showed from Visual Capitalist, just breaking out the world and looking at what percentage of global GDP is South Africa. It's very apparent that investing globally and offshore outside of South Africa is critical. And I spent most of my career thus far helping South Africans who've externalized their money invest globally. And that's really much at the sort of the bread and butter of what I've been doing for the last sort of 15, 16 years. You wouldn't tell by my accent because I can't shake my Joburg accent, but I've been living in London since 2004. And so, yeah, it's very much an offshore investment game for me. Give me 1 second.
Yeah. Maximize it. Yeah, full screen mode.
Just getting there we go. That looks better. Tech support just stepping in to help me. But yeah, so a lot of the clients with whom I've worked over the last 15, 16 years have made their money in South Africa. It's their primary location. It's where they live, but they often don't know where the next generations are going to live, where they're going to retire, and where their money needs to be spent in the future. And so offshore investing is often in the eyes of the beholder. How much do you have? And how much can you afford to take offshore outside of your primary residence, your holiday home, your spending needs in South Africa? And that's why it's important to have financial advisors to work through all of that with you. But there's no doubt there's an importance for an offshore component. And so how does one build an offshore portfolio, and where do you start? A lot of South Africans have historically thought in dollars, pounds, euros, Canadian dollar, Aussie dollar, often where South Africans have moved and where they might have family. And those are good offshore currencies, but is that representative of the world? So we like to look at the world from a blank sheet of paper perspective and try to build global portfolios which don't have too much of a bias to one jurisdiction. Because if you're working with an American firm, they might have a US bias. If you're working with a Swiss firm, they might have a Swiss or European bias. If you're working with an Asian or Japanese firm or firm in Singapore, they might have an Asian bias. So if you try and look objectively, how do you build that global portfolio? And so that's very much about what we do. Bit of background about OMBA. So as Duncan touched on, I set up OMBA in 2017 with a friend of mine from Wits University who had a skill set very different and complementary to mine. He had information systems and technology background. I had more of an investment and client dealing background. And so we came together to offer really a much better value proposition for savers. And we felt we could disrupt a number of things in the investment industry. And at that stage, I'd been doing a lot of research on ETFs as a building block for multi-asset portfolios. And as Duncan touched on, they're really a fantastic tool to construct a diverse portfolio in a cost-effective manner, while it's still expressing quite an active view. And I'll touch upon some of that. So we've been going nearly 5 years now. We've got in rands quite a big number of assets north of 5 billion. We're regulated primarily in the UK and in South Africa by the FCA in the UK and by the FSCA in South Africa. We're also regulated to give advice in Switzerland. And then we're also regulated by the Central Bank of Ireland as an investment manager of a UCITS fund. All the funds that we've set up to date, which is there's currently 1 and 2 that are imminently launching, are Irish UCITS fund. Now that might not mean much to you, but as Eugene touched on, jurisdictional credibility is very important. And Guernsey is a great jurisdiction, and it's good to hear about Momentum using the Guernsey regulatory framework for their setup of their business. Because when you send money offshore, you have to be comfortable that the jurisdiction in which you're operating has got good governance, rule of law, control environments, etc. And UCITS funds, which stands for the Undertaking for Collective Investments in Transferable Securities, is an EU framework to protect retail investors, to ensure that the funds they're investing into are governed by the strict framework. And the two main hubs for funds of this nature are Luxembourg and Ireland. And so we opted for Ireland, probably because we want to be able to go over and watch an autumn international once in a while, watch the Bucks beat the Irish. But no, it's a great jurisdiction. I've done business there in my prior life at Goldman Sachs, and you know, that's very much where we will continue to sort of work with our funds business. Little overview of the team. I won't go into everyone's biography. If you want to read more, you can visit on our website. But you know, we're a 6-strong team, a core investment team here. We've got a non-exec director in South Africa who's actually the founder of Ethos Private Equity, Andre Roux. And then we've just hired another analyst who's joining us on the 8th of September. Everyone in this picture was born in South Africa, so it's not by design that we're all. You know, in many respects, it's great that we're all South Africans and we come from the same place. In some respects, you know, 6 white males on the screen is not ideal, but we've come together for differing reasons. In terms of introductions, we've had word of mouth, people sharing the same vision about how we can disrupt the industry, and you can read a bit more about each of us on our page. Just a little bit about our firm overview of our value proposition. The term ETF manager was used. We're not actually an ETF manager. We don't run ETFs. What we use is we use ETFs as a tool to build portfolios. So we're ETF specialists. We help navigate the universe of thousands of ETFs. You know, there are over 7,000 ETFs in the world. Where does one start? You know, what jurisdiction should they be in? And we'll touch on some of the considerations in selecting ETFs, but that's very much at our core is how do you build a portfolio of ETFs? We run an active process, so we express active views. We're very global in our thinking, and then independent and transparent. So, you know, we're independently owned. We don't have a bulge bracket firm that owns us. We can, you know, we're not tied to any product providers. We're very transparent in everything we do, fees, etc., etc. So those are sort of the core of our value proposition. This is an overview of the types of portfolios we run. So in the funds world, and this is the green block here, as I mentioned, we've been running the moderate risk multi-asset portfolio since 2019 now. And the reason that one's been going first is because most of the clients with whom we dealt that came with money from South Africa offshore weren't really sure whether they should be 100% equity, whether they should be sitting in cash. You know, they knew their assets needed to grow above inflation. And in the experience I'd had at Goldman Sachs and then in my life in OMBA, is most people opted for moderate risk. They didn't want to take too much risk because they often had a lot of domestic risk in South Africa in rands or in their business that they were running, or it was illiquid risk, or this was a private company or a large stake in a public company. Often people had concentrated risk either through currency, jurisdiction, or actual business. And so when they went offshore, they wanted to have a nest egg that wasn't dormant and just sitting in cash. Okay, although that's comforting from an inflation point of view, you lose money over time, but growing modestly. And so moderate risk tended to be the most popular strategy. We'll touch on some slides on interest rates just to give you a flavor of why you may be deterred from a moderate portfolio over aggressive or full equity. But we've got that fund in place. That's the top one, moderate risk fund. And then we're launching a global equity fund and a global thematic fund. Touch wood, in the next couple of weeks, we're in our 5th round of comments with the Central Bank of Ireland. They've been working through the supplement and prospectus with us. And then on the separately managed account side and the model portfolio side, we run a number of other strategies. These typically cater to ultra high net worth and family office type clients. When we got going, the minimum client that we dealt with in terms of AUM was officially $5 million, 4 million euros, or 3 million pounds and upwards. And for those, we could run a bespoke portfolio. So in the separately managed account business, we run separate accounts at a custodian. We now have our own custodian as well, where we'll run the portfolio of ETFs for the client in a very bespoke manner with consideration of tax and their specific risk needs. The model portfolio service is something we do a little bit less, but it is possible where our portfolios get loaded onto a platform, and then people can track the portfolio off that platform. Just a sort of overview of the investment process. So we've got to determine the investment universe. Now, it sounds straightforward, but not really, because not all countries are investable. So we're global investors, but it's very difficult for us to express a view, should we wish to, in Venezuela or the Congo or Zimbabwe, or you name the jurisdiction, you got the message. Not all countries are investable. So it's understanding what is the investable universe, and then understanding what tools are available in terms of the ETF world for us to get access to that jurisdiction. So that's sort of step one. The next step is devising the strategic asset allocation. So that speaks mainly to the risk profile and how we want to have our long-term vision for asset mix in place in terms of region or regional geography specific or factor specific. And then we go down to the next step and we look at tactical. So this is where we're looking, and we've got a slide which speaks to this a bit more, but we are thinking about the world from a macro perspective, from a valuation perspective, from a growth perspective, from a thematic perspective, and saying, where do we tactically think there are opportunities for us to try to do better than just owning a passive portfolio of ETFs that does nothing? And so we will shift the portfolio, and that we call tactical tilting. We then apply a risk framework over that. So we wouldn't want to, let's take a good example. When Trump was elected, and we were building our portfolios in 2017, and he had been elected, as you will may remember, he wanted to build a wall along the border of Mexico. He wanted to break down the NAFTA agreement, which he ended up changing. And there was a very negative rhetoric towards Mexico. So the Mexican stock market and the Mexican peso crashed. Now, presented an opportunity to potentially buy Mexico. So we did our homework and we decided we want to tactically overweight Mexico. And so instead of picking stocks in Mexico, like buying, 5 counters off the JSE, buying Billiton and Anglo and Naspers or whatever, we said, let's own the whole index through an ETF. And so we looked at the ETFs that were available to us, but then we also had to size it appropriately. What was the appropriate sizing of a tilt towards Mexico? And to give you some context, in a module portfolio, that was 2%. So we took 2% out of broad emerging markets and put 2% into the Mexican stock market. And we bought the entire market through an exchange traded fund. So it would be akin to using a Satrix tracker for the South African market, whether it's the JSE All Share or top 40 or whatever. So that risk framework is very important, particularly at the time of implementing a tilt. And then looking at how things correlate within a portfolio context. So when you add something to a portfolio, how will that position correlate with other things you already own? Obviously, Mexico is got the peso risk, it's got emerging market currency risk. It's also in the emerging market index. So it actually has a high correlation to South Africa. So when you're looking at portfolio construction, we're looking at that risk framework as well. And then as I touched on the ETF selection, how many ETFs are available for you to express a view in that particular market, whether it's a country, a sector, or a theme, and we'll touch on some of those. And so which ones do we use? Which ones are most liquid, most credible, with tight bid-offer spreads, with the right tax framework, a whole host of checks we perform. And then once that's been implemented, monitoring and rebalancing is important. So, if you picture a 50-50 portfolio, when you start 50% bonds, 50% equity, and equities rise dramatically, let's say they rise 20%, and all else equal, you've got now 60-40 weight, but your target's 50-50. One needs to rebalance back to your target. And similarly on the downside, like when the COVID sell-off occurred last year and equities, global equity MSCI index fell 34%. So your equity components falling significantly. Who's rebalancing you back to target? Who's taking from your cash and bonds and investing more into equities for you? And so that monitoring and rebalancing framework, which we have, and there's 4 rules to it, which I can elaborate on at length in a separate call. But those rules ensure that you are not catching a falling knife too early, but you are buying on dips, and that you're letting markets run to a point, but not being too greedy. And so operating within a realistic range and time frame, so that you don't incur too many transaction costs, is very important in the monitoring and rebalancing. This just gives you the overview of the types of tilts we would express. So, the first 2 have in the main been what we've done to date, and typically those are the easiest to often get access to ETFs. So countries, obviously you get lots of countries in the world, and there are lots of ETFs on those countries. There are lots of different sectors, financials, technology, consumer staples, utilities, materials. You can often get sectors within major markets. So you get US sectors, European sectors, Chinese sectors, Japanese sectors, and you can express quite a nuanced view. looking at sectors and countries. And then more recently, I'd say certainly in the last 2-3 years, there's been a boom in thematic ETFs, where instead of owning a fund manager that invests in robotics and automation, you can now own an ETF which tracks a robotics and automation theme, and there's an index provider that's created an index that meets certain quality various criteria, and there'll be an index documentation which explains how the index is created, and an ETF which tracks that index made up of those underlying companies in that theme. And so we can now express thematic views. So if you think of things like cybersecurity, very important theme, cloud computing, battery value chain, blockchain, we just touched on some of them there. These are themes that are very front and center of everyone's mind. And you might think this is a great way to invest for the next few years, but then you've got to consider what's the price I'm paying for that growth and for that theme. And so we'll go look under the hood. What is in there? What are the stocks? What is the theme? Is it appropriately valued? And then the last is factors. So if I give you a simple example, in terms of factors, so factors are things called smart beta or factors, are ETFs which track different indices that have been created from a core index that was, from a core index they create a sub-index. I'll give you an example. If you look at the value factor, if you took the S&P 500, the largest 500 companies in America, and you wanted to screen for value stocks, what happens is they would screen for companies of those 500 that have low valuation multiples, low price to earnings, low price to book, low price to cash flow, etc. And those stocks would be deemed value stocks. The stocks which traded on higher multiples would be deemed non-value stocks. What the factor does is it reweights it, and it gives you a greater allocation to those which exhibit value characteristics and a lower weight to those which don't. And so you get factor ETFs that can screen for size, volatility, yield, quality, etc. Momentum would be ones which have recently performed well. So we also include those ETFs in our universe of ETFs to build portfolios. This just gives you a little flavor of how do we come up with a tactical tilt. Obviously there's lots of news that passes over everyone's desk every day, and we actively seek out lots of news, and we sort of, with a macroeconomic hat on, you're looking at central bank policy, you're looking at geopolitics, and we're trying to see where's the next opportunity. So a lot of news, a lot of ETF providers are constantly sending us interesting things relating to their products, whether it's related to country or sector. We've got the product providers obviously want us to use their ETFs as well, so we get fantastic research from them. We then perform lots of our own internal research. In the earlier years of OMBA's life, it was quite tough because we had to build a lot of the templates and tools. But now, 5 years on, we've got fantastic technology that we've built. We use tons. They've been a technologist, and also they're having quite a young team. Everyone's embracing technology in the business, so we're able to digest swathes of information and pull it together really nicely. And we'll do a lot of our own internal research, and then we find the ETF characteristics, but we've got to consider, when you trade this ETF in the market, how wide is the bid-offer spread? Is it better to trade it on the exchange? Is it better to trade it with a primary liquidity maker? So on or off exchange, what's the best time of day to trade it? Is it a US index that we're trading and it's best traded in US time? Is it market, and should we rather trade early London time? So there are lots of considerations in actually executing that trade within the portfolio context. Again, applying the risk framework. Again, I spoke about various limits, but I won't go through all this wording here. But we've got rough guides. Some are soft limits and some are hard limits on the sizing within a portfolio. I touched on the Mexican one. Similarly, if China is 10% of our strategic allocation, this is the first bullet point, and the allocation should be within 8 to 12% if we've got a 20% soft limit. So we could tilt, as I've mentioned, up or down by a further 2%. If a country like South Africa was in our strategic allocation at 1%, and you have a 20%, go down as low as 0.8 or up to 1.2, we wouldn't do a trade for 0.2 or 0.2 either way of a 1% allocation. So that's why we just explained that it's a soft limit. One has to be practical or considerate of the absolute notional size. But there's a risk framework around the sizing of positions. I'm sure Duncan and the team at Perspective would have explained a lot of the benefits to ETFs to you. They're low cost, they're transparent, they're often very tax efficient, certainly from a withholding tax perspective. They're very liquid, multiple asset classes. You can express tons of views on them, and they're very diverse. The benefit of ETFs is you have inherent or positive selection bias. If you think about it just simplistically, for a company to enter an index like the FTSE 100 in the UK or like the S&P 500, that company would have had to have done very well to grow large enough to enter into that index. And similarly, those companies that are falling and shrinking and performing poorly are exiting the index when it gets reconstituted. So over a long period of time, you're constantly owning more of the winners and getting rid of the losers in a very diverse manner. And so we love ETFs as a tool to build portfolios. And then I've touched on considerations already in many respects. In terms of the ETF selection process, I won't go through all of these, but effectively we apply a proprietary framework here, which gives each of these characteristics a score, and ETFs get scored up or down based on these characteristics. And then in aggregate, we will come up with a negative or a positive score for that ETF based on these characteristics, which means we might downsize or upsize that position based on our initial thinking of what the appropriate size was. Portfolio monitoring and rebalancing, again, I touched on that in the earlier slides, but the key point really is it instills discipline in the investment process and make sure you've got the appropriate level of risk at the right time for the market cycle. Economic outlook and positioning. So, where are we today? I think, everyone always wants to know, as speaking to investment managers, what do you think about the world now? We're cautiously optimistic would be a good summary, which is a cheesy term because people use it in finance and banking and asset managers all the time because they always want to hedge themselves by saying cautiously optimistic. But we're optimistic primarily because of the fact that both fiscal and monetary policy for major central banks is quite loose, and that's very supportive. Although coronavirus and COVID news has not abated and there's still cases rising in many countries and the state of COVID is not great, it is better than it was. And so there's still scope for further unlocking because we're not out of the woods yet, but we're getting out of the woods. And so coupled with fiscal and monetary stimulus and potential further positive news on the COVID front, whether that's vaccine rollouts across more of the world and not just the developed countries, and an increase in trade and travel, etc., we think it bodes well for markets, for equity markets and risk on the whole. Having said that, equities have run very hard since the lows of the COVID sell-off last year, and a lot of people will look to valuation multiples and say that they're quite high. And you could argue on the one hand that multiples look very high and equities are expensive, but on the other hand, you could say they're actually quite cheap when you compare to bond yields. And I'll show that to you in another slide shortly. But bond yields being low is huge stimulus for households and companies, and that then supports consumption and companies making investment because they can fund themselves cheaper. So if you can get a loan at a low interest rates for your house, or for your credit card, or for your car, or your company, and you need to get a loan and you can get it at a low interest rate, that is supportive for growth. And there's a relationship between earnings yield on companies and bond yields. And there's a model called the Fed model or the Yardeni model, which is worth reading about if you're interested. But on that basis, equities are actually cheap. And you could argue bonds are quite expensive. And, so what is the right multiple to pay for a company's stream of earnings? Is it the historic 15 to 17 on the S&P 500, or is it the current 22, 23 on the S&P 500? One has to not just look at it absolutely, one has to look at it on a relative basis to what bond yields are at the moment. So overall, we're pretty optimistic. And to give you some sense of positioning, the lowest equity weighting we've had in our moderate portfolio is 43%, and we're currently at about 60%. So we increased that weight during the COVID sell-off. We actually entered 2020, fortunately, at the lower end, at that 43% mark, having trimmed risk end of 19 after 2019 was such a strong year, which gave us some more dry powder from our bonds and cash to deploy into the COVID dip. And we're now sitting at 60, and we're comfortable there, certainly for the foreseeable future. That just sort of gives you, in terms of interest rates, we're on the shorter end on duration. So just touching on that here, if this means little to many people because durations are sometimes a tricky concept. But there's a thing called interest rate sensitivity in a bond. And the longer dated your bonds, the more sensitive they are to a change in interest rates. So having duration at 4.3 means the portfolio is less sensitive to a rising rate environment, which we think is sort of the next move from here. Jumping just to the slide, I think graphically depicting how low interest rates are is important. You could see the 2-year yield, and the 10-year yield, both very, very low, driven by Fed funds target rate, which is the black dotted line. We've gone back here to sort of the late 70s, just to put things in context. Obviously, at this period here, north of 15% with the inflation spikes of the 80s, which some people would remember, some of us not. But bottom line is we've been in this massive bond bull market for many, many years. And so it makes investing in fixed income a very interesting conversation right now because your yields are so low. What is the point of owning fixed income? And we actually wrote a piece on this, which you can pick up on our website under publications on fixed income if you're interested in reading more about why we think it's still important to have fixed income in a portfolio, even when yields are so low. Again, that's sort of touching on the asset allocation weight. There's our equity weighting now at around 60%, fixed income 37.1. An important point to note is that most of our fixed income is high quality investment grade fixed income. That would be, equivalents of treasuries, gilts, bonds, etc., and investment grade corporate bonds. So corporate bonds of investment grade issuers like large corporations like Apple or Amazon or any of those big companies that issue debt. And then equity breakdown, just worth noting, we typically have a lower weight to the Americas than many of our competitors and peers because we think Asia Pacific region continues to grow at a faster clip than the rest of the world, as you're seeing by the rise of China and India. And so we've got a little bit more than you would often see in a global equity portfolio in Asia Pacific and a little bit less in Americas, but Americas is still the largest weight. And then 3.3 in cash. 3 of our recent tilts that you can see in the portfolio, we've tilted to China internet stocks via an ETF. Obviously, they've come under a lot of pressure recently. So valuations have driven that on a relative basis to US. It's almost like I don't say it's a screaming buy, but it appears to be an attractive entry point if you take a 10 or 15-year view on China and its internet traffic and growth. European healthcare we entered into earlier this year, driven off the back of healthcare getting hit quite badly. Ironically, because of COVID, because a lot of elective surgeries and other things that people would typically have done to them during a normal period were not able to be done. And so a lot of hospitals and healthcare related companies, whether pharmaceutical companies selling anesthetics and the like, were unable to conduct these surgeries. And so the healthcare sector actually had quite weak earnings because of COVID. So obviously a lot of the big players benefit, who produced vaccines benefited to a large degree, but many other companies suffered. So presented a great opportunity to enter into European healthcare. And the stocks in that sector include the likes of Glaxo, Novartis, Roche, you name it. They're all the major healthcare companies in Europe. And then on the factor conversation we touched on earlier, we've currently switched out of. So we went into a US minimum volatility factor ETF preceding COVID. COVID happened and that actually outperformed the S&P 500 quite well because it had less volatility than the S&P 500. And then we entered into the value factor ETF in the back end of last year, again driven by attractive valuations and a shift from growth into value, which we saw in end of Q4 last year and in Q1 this year. And more recently, as we think the market cycles, the initial bounce from the sort of post-COVID lows has happened, we think that it's important to have greater quality companies. So we've now got the quality factor bias. So a lot of the mega cap companies, names you'll be familiar with, will be in that ETF. Just to give you a sense of how diverse our portfolio is, when you look at the underlying equities, there are over 4,100 underlying stocks. The top 10 only make up 5.24%. So, if, I don't know, Enron, WorldCom, Lehman, Bear Stearns scandal occurred or Steinhoff scandal occurred, you're not going to lose your shirt because we're extremely diverse. We're tilting by huge sector, country, region. And so it's just important to keep in mind, market cap, the median market cap is $4.7 billion. you know, the weighted average, obviously skewed by the mega caps, the trillion dollar companies, means the weighted average is higher. P 23, so it's not a crazy multiple of 40, 50, 60 like you see in some of the tech names. Dividend yield is decent actually, 2.45%. This is when you drill through to all the underlying companies in the portfolio. And then the ESG score is the blended score of the score that we get from all the underlying companies. Give you a sector breakdown. You know, we've got mostly IT, followed by healthcare, financials. You can read this for yourselves. Country breakdown, again, equities, United States make up the bulk of it, but we do have a greater shift there. You see 11% to China. You've got Japan, and you'll see some other Southeast Asian. We've got a tilt towards Korea as well. Again, on the fixed income side, important, there are 950 fixed income issuers if you drill through the ETFs, making up over 5,000 underlying bonds. You know, weighted average coupon 3.22, yield to maturity, as you saw from the chart on interest rates, very low. But these are yields that at least get you close to inflation. And then the credit quality is obviously very high. Looking at thematics, I mean, this just gives you a sense of some of the themes we're looking at. And I mentioned that we're launching this new fund. The reason we're launching this fund is that a number of our investors have been following these themes and said, we want to own more of this and more of that. And I want to have a punt with my own money and invest X amount in biotech or food or water or aging populations. What should I do? Should I pick 10 themes at 10% each, 5 themes at 20% each? Or is it the right time to do it? Has it run too hard already? Having had a lot of feedback from clients, many said, why don't you do this in a fund format and you guys work on building a thematic portfolio for us? Because we've already been considering all these themes for our main portfolios. We already use them as a tool to build our main portfolios. And so this just gives you a flavor of some of the themes that we look at in our portfolios. And then again, the importance of having a specialist help you navigate that. In climate change, we all know it's important. There are 12, at the time of writing, there were 12 underlying ETFs. Clean energy, there were 5. Cybersecurity, there were 4. This is on our shortlist. So yeah, thematics is very much important to us. Again, just touching on the themes. I won't go through all of those. And then lastly, why work with OMBA? Obviously Duncan and his team have been very supportive, and we hope to build a long-lasting relationship. But we're a global firm, just going from the right, global firm, very cost conscious. We don't want to overcharge customers. We're specialists in ETFs. Ethics are at the core of who we are. We're independent. We're not owned by bulge bracket firms, manager owned, well regulated, as I touched on, 4 jurisdictions. Very grounded and humble in what we do. We can pick, anyone can pick up the phone and call us and have a chat. Again, transparent, fair, avoiding conflicts of interest, passion for investing, integrity, client's interest first, aligning of interests, and embrace technology. Those are, in our view, the reasons to work with us. And then the top right, we were fortunate enough to be the winner of the emerging manager category in the private asset manager awards in 2020, which was great. So, we've also done well on the investing front. So that sums it up, really. I'll take any questions if there are any.
Thanks, Mark. Appreciate it. There's one question for me. You said the Verdeni model somewhere in your thing. What if you just maybe give the actual writing of that so I can send it out? Sounds like something quite interesting.
Yardeni model.
Yeah.
You could go to yardeni.com if you're interested.
Oh, Yardeni. Okay.
Yeah.
Cool. I haven't seen any questions in the chat. We have had a couple. We've answered them. I don't know if anybody had just put their hand up, and we'll add them. I think just to add to this, I think the most important thing is the asset allocation, which is such a vital part of anybody's asset management. And that is specifically why we've engaged with OMBA to put together these portfolios for us, obviously on the offshore side, and actually we engage them on the local side as well. So you guys will see these come through in the investment sort of strategies and the wealth management strategies that we are implementing as perspective with OMBA in our pocket, which is quite amazing. So thanks, and I really appreciate the presentation, Mark. Has anybody got any questions right at the point? It is already 5 o'clock, and I know I booked this only for an hour, guys. I know I like to try to keep things to the timing, so if those who want to drop off, please feel free. And those who want to stay for any Q&A, please do so as well.
Yeah, sorry, I was rushing through it to try to stick to the time. I had Stephen giving me time cards here. Hurry up. So I could speak for hours on what we do, but I'm happy to answer specific questions.
You and me both. You and me both. Anybody got any questions? I've got one. Cool. Chinese internet obviously changed the legislation with now they're only letting their kids play for like 3 hours a day. I think 3 hours is crazy. I think would make my daughters go mad if I let them play for 3 hours a day. But is this one of the reasons why you said there's a little bit of chaos there? And obviously the strategy still remains. It should still be a long-term investment.
Yeah, I think if you think about China, a lot of the legislation that they're imposing, whether it's relating to that gaming specifically, or it's looking at what the reforms of education, which was the sort of big headline. A lot of these moves are actually quite Western in their thinking. They're wanting to improve their country and what they offer their people. I mean, having a cap on how many hours per day your children can play games on their screen is good. Now, it's obviously going to impact companies, but a lot of the changes that China have been implementing, a lot of the antitrust legislation as well on big internet is good legislation. Antitrust legislation occurs all over the world. So when one looks sort of at it with another lens, you could say actually China's maturing and westernizing a lot of its legislation. Now, it still is a totalitarian state and it can do what it wants to a large degree, but they're too intertwined with the rest of the world now. That we can't ignore what they've done and what they're doing and how fast they're growing. And the scope for Chinese internet users to grow, even though they're one of the largest in the world already, is huge. And urbanization is continuing as well. And so I think what's going to happen over time is that government is going to work better with the corporate sector in China. And a lot of these headlines in a year from now will be gone. And everyone will look back and will say, I wish I bought it on the dip. Having said that, sizing is appropriate. So we're not putting 20% of the portfolio into China internet. We're thinking of sizing somewhere between the 4 to 6% mark of the total equity allocation, to give you a sense of how we would size that. But yeah, those news flows are worrying, and that's what presents the opportunity. So good question.
Thanks. I do try. It's kind of what I'm here for. So there was one other question. I mean, it's just around the cautious optimism. I think it's kind of fence sitting, but I do get where it is at. I think one of the things that I like to stay there is I saw a presentation from Neg Group Investments today, and they showed you what would happen if you had pulled out of the market in 2019 and then try to get back in. And it's that whole thing about time, just staying in the market and the time in the market. And I think just for everybody here, if you're always cashing out and trying to get back in, you actually lose out, and you lose out upwards of 20-30%, and because you're always battling, when do I get in, when do I get back in? And that just staying in the market is one of the most powerful things anybody can do.
Yeah, it's time in the market, not timing the market. That's important. Exactly. So that, we're actually going to publish a piece in the next few weeks or week or two on staying invested and staying the course, looking at some of the data relating to if you missed the best 5, 10, or 20 days of the calendar year from being invested, how much that would impact you from the investment point of view. So, very, very important to make sure that you're not panicking in a sell-off. And obviously not being too greedy as well, when everything looks exuberant, not piling in and investing too much more into equity if it's against your long-term allocation. But the reality is that the best asset class to own for the long term and to beat inflation over time is equity. But you don't want to have all your money in one equity like Steinhoff, or just 20 shares. So unless you're involved in a business, you run the business, you're close to the action, you know what's got, and you're managing the business's diversification, I think it's silly to have concentrated portfolios of 10 or 20 shares. People love to do it because it's fun to talk at the dinner table with your buddies and your friends and say, I've got this stock and that stock, and have a conversation. But actually, if one of those stocks is a Steinhoff and you've got a significant portion of your wealth in that portfolio, it can take you out. But equities as an asset class deliver the best return over time. And time being, that should be a time horizon certainly north of 5 years, but ideally north of 10 years, so that you can ride out the peaks and troughs of the market. And so as people get more liquidity, they should just continuously allocate more to equity. And then, be always conscious of how much you might need for a rainy day, and what percentage in cash should you retain if you have a medical need for a family member or an emergency or something, you know, so how much should that be? But outside of that, my view is north of 70% should be equity long term.
Yeah, perfect. So we do try and like make as much as we can in terms of getting all the information out there, and we will obviously build portfolios for clients and try and get that allocation correct. But it's very important. So if you look in front of you guys, I've shared the screen. These are the portfolios that OMBA put together for us earlier this year. And these are the ones on the MWI platform actually right now. And some of our clients actually on this call have actually been invested in this already. But you'll see if we go through it, and this is where Mark was kind of talking about whether you're going to be cautious, moderate, or aggressive, and whether we blend these a little bit more with some of the thematic tilts that OMBA has. These are just the initial portfolios that we have been put together, and I have sent this to some of you guys. We've got the conservatives, and you can see the allocation to the OMBA moderate fund. We've got the slightly more allocation to the other asset classes, just to give you a bit more of an allocation to asset allocation to equity or fixed income, guys. But this is just an idea. You got the aggressive, the moderate, and then the conservative, the moderate, and the aggressive, and it just shows you what we can do within the platform that we have with MWI and with OMBA's participation. So if anybody does, obviously there's some people here that you're talking to, and everybody does have any questions, please feel free to get in touch with us after this. We can happily set up a call with Mark and Stephen outside of this as well. So if you didn't feel like you wanted to answer any questions, or you think of something afterwards, or we just want to have a quick chat to me or to Stephen and Mark, happy to arrange that. So just let us know.
Yeah, with pleasure. I can hear the hardy-dars in the back with someone else. It was making me homesick.
That's my house. It's lucky the dogs. It's lucky the dogs and the kids haven't come running in. Those would be one of those like crazy things that happens on the BBC. Luckily, but they've been trained well. I'm trained my daughter as well. Okay, cool. Guys, I haven't seen any other.
There was one on renewables, I think.
Yeah, just answered.
Oh, okay, good.
Yeah, okay. All right, cool, perfect. As I say, guys, if you have any specific questions, please feel free to raise them afterwards. I will add this on some kind of viewing platform so we can put it out there if anybody wants to watch it afterwards. But yeah, thanks so much, Mark. I don't know if Eugene's still on the call. I think Eugene's dropped off. But yeah, if anybody's got any questions on anything, let us know.
Thanks so much.
Thank you all.
Bye.
Bye-bye.